Assalamu Alaikum everyone, welcome back to the channel. In today's video we're going to look at 5 different companies that are into technology sector that you could add to your portfolio. These are dividend paying companies. I'm only focusing on companies that have a free cash flow. Okay, so companies basically that are making profit at the moment, and the technology sector obviously has a lot of companies that are not at the moment paying any dividend. They're not making any money, but they are obviously growth companies and so on. But we're only going to focus on those who have a positive cash flow. But before I start on this, can I ask you, if you are new to the channel or you have been with us but you haven't subscribed yet, please subscribe to the channel, because I'm sharing my journey. I want to help others just like myself, and inshallah the more people that like the videos and obviously subscribe to the channel, the more people will see the videos and so on, and that way we can help a lot more people. Now the reason I'm doing this is because at the moment on YouTube there's not that many Sharia compliant channels that are sharing their journey and obviously helping others, and this is the reason I started. Especially in the UK, we don't have that many at the moment. To be honest, I don't think there's that many at all. So please just like, subscribe, let me know if you have any questions. Okay, have a look at my Instagram account. I always post in there, so anytime I buy new stock or whatever, or I get paid dividend or whatever, I share that with you. So I'm sharing my journey every single day, and hopefully you will enjoy that as well, and obviously find some value in these videos. Now this is my portfolio and this is my passive income, so it doesn't include companies that are basically not paying dividend. At the moment it's valued about $32,000, over $32,000, annual income of $720, dividend yield of over just 2%. Now one of the things I'm trying to do is buy companies that are blue chip, that are not basically cancelling their dividend anytime soon. That's why you see 97% is likely safe. Okay, and this website that I'm using is called Simply Safe Dividend. Okay, so have a look at that if you're interested. The beta here, what you see is basically if it's above 1, that means the company is basically volatile. Anything below 1 is actually good. Now one of the things I'm planning to do in the next few weeks is to look at each one of these sectors, okay, and maybe pick about 3 to 5 companies that I think that you would want to invest in, and hopefully we will find some values in them. So I'll start with the technology sector today, and then we'll take it from there. But if you have, like I said before, if you haven't subscribed and you find it value in any of these things that I'm talking about today, then please like and subscribe and let me know if you have any questions. So the first company that we're going to look at is Cisco. Cisco is a networking company. It is one of those companies that have massive products around the world. They work with a lot of big companies, small companies, just from basic schools, from networking, from just like small companies, big companies. Like I said, it's one of the biggest basically networking companies. And one of the things I love about basically this company is the fact that they have wide diverse of products. So from basically setting up a server, setting up routers, setting up wireless communications, wireless access points, basically anything to do with video conferencing, the Internet of Things. And one of the things they're doing currently is trying to diversify their portfolio so they become more of a subscription company. Okay, because that's where the money is these days. If you can get basically subscription based software, that is basically where the money is. And a lot of companies like Microsoft and so on, they've now moved on to that stage. They're slightly behind, but I'm sure they will get there, because they I'll show you basically some of their financials today, but it is really one of the biggest companies out there. Like I said, is obviously in the technology sector, currently trading $53. Now it came down a little bit, and I'll show you that in a second. A PE ratio is gone up actually, sorry, but it was actually a lot lower than that. In fact, I can show you that now. 52-week low of 35, so it went down as $35 per share and is up as 53. So this is the highest it's been in the last few months. And in fact 2020 hasn't been a great year for this company. Around that time, basically you would have picked a share of this company for 35, you would have made at least $20 per share if you bought that. Again, I really like the company, but at the time I wasn't sure whether I should add more technology companies, because my portfolio have actually got at least 5 different companies, and I've invested quite a bit of money. So I just want to diversify, but this was on my watch list for a long time. Now, like I said, the PE is about 22. Now 20 is the basically less than 20 is basically what we look for in this channel, but obviously if it's more than 22, especially with the technology company, that is okay. 22 maybe up to 25, it's okay. I think I would still buy this company at about 23, 24. What this means is basically I'm planning, by the way, in fact what I'm doing is very soon I'm going to create a few small short videos just to explain what like things like PE is, for example, like free cash flow and EBITDA and all these basically ratios that we talk about all the time. I'm going to create short videos to explain what they are. But what this means is basically if you bought this company at this PE ratio, then that means it will take you about 22 years to get your money back. Basically, that's what it means. Okay, and you can imagine when you look at the Tesla and other companies that are trading at the moment, 1500 PE ratios. that's how long it's going to take you to get your money back. So market cap is about over $200 billion, forward annual and trailing annual dividend yields. Now I've included the trailing because this shows us basically where the company was 12 months ago, and this is what they're currently paying. So I want to see that they're increasing their dividend. So from 2.8 to 2.9, you can see they've increased their dividend, and again, that's what I want to see. When it comes to 5-year growth rate, okay, of 10%, really decent, really good. Okay, dividend growth for 9 years, so they've been paying their dividend over basically 9 years. The payout ratio, so out of their net income, so their net income, the money that they receive, they're spending about 45% of that money or 46% of that money paying back dividends. Okay, we normally say anything below 61%, that is really good. Okay, above 61, you just have to be careful. Sometimes the cutoff is 70, some people say 70. It depends on your appetite and basically what you're looking for. Free cash flow is the money they use to pay the dividends. So they've got, and also basically reinvest in the company and pay debt and so on. And that's about 14 billion dollars at the moment. Okay, we've talked about this one already. The beta is basically less than 1%, so they're not volatile. So when the stock market goes down, they don't go down as much. Profit margin, we normally say about over 15%, is 21%. Return on equity. So what this means is, and again, I'm going to do another video on this one, but what this is they take your money. What do they do with it? They actually use that money to generate more returns and more profits. So the return of basically that ratio is now 27%. So 27% is great, because normally what they say is anything above 15 or 20% is really good. So 27 is excellent. The company is currently undervalued, okay, according to Simply Wall Street, and it's a buy. So that is the first stock that we're going to look at. Now we're going to look at the second stock for this in this video, and that is Microsoft. I'm not going to go through what Microsoft does. I'm sure you know and you've used some of their products, but obviously from having the Office, from cloud computing, from Office 365 security, but they are they're the second biggest company in the world right now. Now, share price of $252 per share, PE ratio of 34. Again, these mega caps, that's what we expect. Okay, market cap of 1.8 or almost 1.9 trillion dollars. Forward PE is 0.89, and basically trailing annual dividend was 0.87. So they have increased a little bit. Okay, for last 5 years they've increased about 10%, and they've been doing this at about 17%. Payout ratio, look at that, 29%. And some of these free cash flow they've got $53 billion in the bank that they can reinvest in the company, pay dividend, and basically buy new companies that they like and so on. The 52-week low was $173. I think I started buying when it was 190 or something like that. Okay, and I'll show you that at the end. And then $263 is basically the heights. Okay, so that's basically the highest it's been, and this is the lowest it's been. The beta is actually surprisingly quite low. So when the stock markets are going down, this is one of those companies that actually not as volatile as the rest of the markets. Profit margin 35%. Can you see? From 15, that's double. That's more than double. Okay, return on equity almost to 45%. We're looking for about 15. Again, amazing. And look at this, the fact the company is actually undervalued and currently is a buy. According to Yahoo Finance, is a buy. According to you, Simply Safe Dividend is actually undervalued. Again, that's Microsoft, great company. I own, I think, about 16 shares or something like that. Okay, really great company. If you're interested and you're looking for dividend, you're looking for a bit of growth, and I like the fact that it's a growth company as well as they pay you some dividend. All right, so the next company we're going to look at is Intel. Intel, again, is a chip maker. Basically, they have been around for a very long time. They are by far the biggest when it comes to manufacturing of technologies, the cloud smart and smart, basically, and connected devices for retail, industrials, and consumers used worldwide. So anytime you buy a new laptop, most likely it's actually powered by Intel chip. Now, having said that, things have been not great for this company lately. They've gone through quite a bit of a challenge at the moment. Couple of companies are pulled out, so like Apple is now designing their own chip and so on. But what I like about this company is their financials is great. They've now hired a new CEO. So hopefully in the next maybe 5 years, you're patient and you buy this company now, I'm 100% sure this stock will be up worth at least $100 per share, maybe in the next 5 years. But if you're willing to wait that long, then that is basically what I would that's my forecast for this company anyway. So currently trading at $57 per share, P ratio of 12. They're probably the cheapest technology company out there right now as we speak. Market cap of $233 billion. Dividend, you can see they have increased their dividend over the last couple of years. So 2.42% is what you will get. Their 5-year growth rate is not great, but at the same time, they have a lot of free cash flow, and I'll show you that in a second. They are willing, obviously they're increasing it, which is absolutely fine. Dividend growth of 18 years, so they've been paying this over the last 18 years. Payout ratio of only 30%. So they're spending only 30% of their free cash flow to pay you back. Okay, and they actually do buy back their shares, which is excellent to see. They've been down as low as $53 per share, and now they're trading about 64. Well, that was the day they actually updated, so it's gone down a little bit. So when I put this together, it was about 64, 68, but the market has gone down last couple of days, so now it's actually a lot cheaper than 68, which is really good to see. Actually, I didn't update that, but that's really surprised that it's in about a week. It's gone down that much, because the last week actually hasn't been great, was it? So in terms of beta, it's actually not very volatile. Profit margin, I know what happened, because they reported their earnings and there was some people that were not, basically they didn't like maybe the forecast, the guidance, I think, and it went down quite a bit at that time. So profit margin of 23%, 24%, return on equity about 23%, almost 24%, and is undervalued at basically 33% according to Simply Safe Dividend, Simply Wall Street, and is a buy at the moment, which is 2.8. Buy hold, but I think because it's went down quite a bit at the moment, it might just be a buy, because 2.08 is kind of hold, if you like. Now, if you're willing to wait maybe another couple of years just for this company, you can buy it and hold it and still get paid dividend. Okay, you know that's not going to go away, because they have an amazing almost $19 billion in the bank to actually pay you every single year. And while they're working out what they want to do next and how they're going to come out of this crazy situation that they're in at the moment, then you still collecting your money and you patiently waiting and actually adding to it. I think this is a great buy, for honestly speaking to you. But I haven't invested in this company yet, and the reason for that is, like I said, with Cisco, I do like the company and do like the business model, but the only issue is I've already got a lot of tech companies in my portfolio. All right, so the next one we're going to look at is Visa. Visa is obviously a technology company. Some people think it is a financials. It should be in financials, to be honest with you, but they don't actually do anything in financials. They just create the systems and the products that we need in order to be able to basically send transactions and settle transactions and so on. Okay, currently trading at $232 per share. PE very, very high, 55. I think Mastercard is about 50. This is about 55. They're both very, very expensive at the moment. So maybe I would wait for this company to come down a little bit if you're interested in buying this company. Market cap of $513 billion. They pay small dividend, but you can see it's growing, so 0.55. They've got 5-year growth rate of almost 19%, and then you've got 12 years, so they've been paying this 12 years. Payout ratio very, very small. We're looking for less than 61. It's only 23%. Okay, they've got free cash flow of $11 billion to pay you back all of that, and the lowest that they've been is $232 per share. At the moment they're trading 235, 232 again, so that's the lowest that basically they've been this year. Then your beta is actually less than 1, which is not bad. Profit margin absolutely amazing, almost 50%. Return on equity almost 30%. Is overvalued at the moment. Okay, so maybe, like I said, maybe wait this to come down a little bit. If it goes down about 200 per share, I think I would get in and buy a couple of more shares. Well, I don't actually own it yet, so maybe I'll buy some more shares. It's been on my watch list for a long time, but it's too expensive. Finally, it's a buy at the moment according to Yahoo Finance. So the final company that we're going to look at is Avgo or Broadcom. Broadcom is one of those companies that I own. They basically supply semiconductor infrastructure software. They deal with a lot of the cloud stuff, security stuff, semiconductor solutions and infrastructure. They do a lot of mobile technology. So like when you look at your iPhones, it's actually got chip made by Broadcom. Okay, they currently trading $452 per share. PE very, very expensive at the moment. Market cap of $186 billion. Their dividend is absolutely crazy. They look at that difference. Okay, they've grown their dividends last few years. I think last 5 years they've grown about 50%. I think. Okay, 5 years, there we go, 50%, 51% almost, and they've been doing this over the last 10 years. Payout ratio slightly higher than the other companies, about 53.5%. Free cash flow of $12 billion, so you don't have to worry about any cut anytime soon. They've been low as $254. I wish I knew at this point, because I would have bought loads of shares. I only own, I think, about 4 shares or 4.5 shares at the moment. Beta is not slightly less than 1%, which is fine. Profit margin is probably the lowest that we've seen so far, but slightly more than what we want. And return on equity is also the same. Overvalued at the moment, so maybe just wait for a pullback, maybe when it hits about 400 or 420, 430. Okay, it's a buy at the moment, but I think it's just a buy, so I would wait maybe a pullback. If there's a correction, definitely get in this one. I'm not a financial advisor, but I would honestly advise you to look at this company, look at into their products and see where they're heading. Okay, and because that's really important. Now that is it for this video. Like I said to you before, I'm trying to be transparent, and I'm trying to show you my portfolio and basically how things are going with my portfolio. Now I've got a video coming up, so these are the older holdings, so you can pause it and look at some of my holdings and have a look at their dividends and whatever, how safe their dividends are and so on. So next week, basically not next week, actually tomorrow, I'm doing another video just to share my portfolio again, to show you what I've been, what happened in the month of April. Okay, what I've added, what I've got rid of, and so on. But if you find a value in today's video, please like, subscribe, and let me know if you have any questions. Thank you very much for watching. Assalamu Alaikum.